We're talking about year-to-year variation. This is a little heavy, so bear with us. Do you get bigger variations if you're trading equities? A lot of people go to us, well, I don't like the variation, so I'm just going to stick to indexes. And the answer is, if you do stick to just index ETFs, things like that, or indexes, your variation from year to year, meaning your P&L variation, your return variation, is going to be significantly, you're going to have less variation. How much less variation do you think, Mr. Batista?
Oh my God. I don't know.
Yeah, it's not easy.
I mean, 20%, 25%.
It's about I'm just trying. You wouldn't know. It's about a third. The year-to-year variation between your returns, if you don't use equities, is about a third lower. So then why wouldn't everybody do that? Well, the answer is because when you trade equities, you have a lot more underlying higher volatility. And so there's a lot more opportunity. Just like everything else in this business, if you trade equities in addition to indexes, you can potentially make more money. You also take bigger swings from year to year. That's how it works. Let's take a look at the numbers. Using the Greeks to identify how much risk is in an individual strike is a powerful tool for allowing retail investors to trade with confidence in a wide variety of underlyings. Over the years, traders seem to learn that that's how markets work. But even if every 20 delta strangle was probabilistically the same, the results would still vary over time and between underlyings simply due to chance. So let's see how consistent the results of a disciplined mechanical traders have been over the years. So if we just go by the book, straight by the numbers. So we did a study. We used 15 years worth of option data in the SPY, IWM, Qs, Apple, Amazon, and Google, 3 index ETFs, and 3 of the top NASDAQ stocks. We considered selling strangles with 45 days to expiration, managed at 21 days, no other management, and did the 30, 20, and 16 deltas, okay? We examined the win rates and the net P&L overall to see how much these numbers varied from year to year. So we're going to look at the index ETFs, all right, Bat? And then we're going to look at the individual stocks. First of all, 30 delta strangles for the index ETFs. All the returns were positive. This is over 15 years. So the net average P&L per trade was a positive number. Less in the Qs because the Qs have had just this monster rally, so they've had some drawdowns in there. The 15-year
win. The Qs don't look like that's a net. I mean, I know it's net positive return, but didn't seem like worth the risk.
No, of course not.
With the return that the NASDAQ had done, sure.
15-year win percentage, 75, 76, and 65. Obviously, the Qs, and the annual deviation of P&L is, you're going to see that number's going to be pretty consistent along the lines, and the annual deviation of win percentage also pretty consistent. Things are fairly predictable. The most important thing here is to look at kind of the win percentages, which are high, and the net P&Ls, which are going to be a little bit lower. Now, let's go to the individual stocks. So the first thing that you notice is on the individual stocks, the net average P&L is significantly higher. Remember, the Qs were $4. Google is 148. Sure. Amazon and Apple are 52 and 60 respectively, and the other ones were, I think, 29 and 30. The 15-year win percentage drops way down to about 65%. Now, remember, these are 30 delta strangles. That's still a pretty good win percentage for a 30 delta strangle. The annual deviation of that win percentage is a little higher than the indexes, which it should be, and the annual deviation of P&L is higher than the indexes, which it also should be, right? All this stuff's starting to make sense. If we drop down to the 20 delta strangles, which is the next slide, which is the one we usually do. So what you see here, again, are the Qs probably not worth the risk over the last 15 years, just selling strangles. I mean, the annual deviation of P&L is quite low. The annual deviation win percentage is quite low. And the win percentage is fair, but just didn't make a lot of money in the Qs. IWM and the SPYs, which is why we're focused on IV rank more than anything else. We didn't separate this by IV rank. Those numbers remain fairly consistent. But if you go to 20 delta strangles in the underlying stocks, which is the next slide, which is where we mostly live most of the time, 16 to 20 deltas.
Yeah, but you don't know what the market's going to do. So it's really hard to look at this and say, well, no,
I know that. I'm just making the case for diversifying all your positions.
Sure.
So the argument here is, okay, your net P&Ls are a little higher. Obviously in Google, much higher. Amazon, much higher. Apple, not that much. The 15-year win percentages are stable. The annual deviation of P&L is significantly higher. And the annual deviation win percentages is slightly higher. The reason all this stuff is interesting is because it shows you that if you take more risk, you make more money. And that's it. That's just, this is being totally mechanical. It's showing you that all the numbers scale. and that what makes the most sense is to have a diversified portfolio. If you go down to the next one, which is, I believe, the 10 delta strangle, which we use, 16 deltas, which we do plenty of. You can see that the SPY IWM and Qs over the years, the Qs just didn't pay that much. The 16 delta strangle, which has a theoretical a chance of success around 68%, was always in that 79 to 80% range. The annual deviation of P&L is quite low, and the annual deviation of win percentage is quite low. So you can basically figure out almost perfectly how you're going to do over time, because the annual deviation of P&L is not that great here. The flip side of this is the next slide, 16 delta strangles in stocks. Apple, Amazon, and Google, which are significantly higher than the last slide. The 15-year win percentage, now goes down from 80 to 72, but the annual deviation of P&L only drops a little bit, and the annual deviation of win percentage only goes up a tiny little bit. The reality here is you take more risk, you make more money. You have a slightly lower win percentage, you have much bigger credits, so you make more money. The variation of your P&L and win percentages definitely skews higher when you take more risk.
You get rewarded. I mean, listen, it's all about reward, isn't it? I mean, if you're going to take the risk, you want the reward.
Of course. I think this really lays it out. Super interesting. In every case considered, the year-to-year variation in P&L was more than the average P&L. Okay, that's cool. And then, because that makes sense. Even if we are consistent and mechanical with strategies that are successful in the long run, we need to be prepared for losing years or losing trades by keeping a portion of our capital in reserve and also obviously diversifying. Short option positions in the ETFs considered had about a 33% less variation from year to year in performance than the equities. That's what I said. There's about 33%, about a third less swings. It's about one third less predictable. That's the easiest way to say it. Meaning traders who stuck to those underlyings could be slightly more aggressive with their capital allocation, because you're going to have 33% less swings. Being able to anticipate and prepare for how much variation around average results, it might help us take on the risks that are necessary to make the profits by selling premium with eyes wide open. It's basically just saying, hey, respect the numbers, because the more risk you take, the more variation you're going to take, and the more money you're going to make.